If you want to understand what is about to happen to your money, you have to stop thinking like a voter for a minute and start thinking like a creditor. The federal government is staring at a debt problem that cannot be solved with slogans, campaign speeches, or wishful thinking. It can only be solved with arithmetic, and arithmetic has no loyalty. Right now, the United States has pushed debt relative to the size of the economy into territory this country has only seen in the most extreme moments of modern history. That fact alone is not the whole story. Countries can carry huge debt loads for a while. The real question is always the same. How does a government service obligations that have grown larger than the productive engine that is supposed to support them? There are only a few answers to that question. You can spend less. That is austerity. It is mathematically clean and politically poisonous. You can refuse to pay. That is default. It is catastrophic for any government that wants to keep borrowing in the future, which means governments talk about it in academic circles and avoid it in real life. Or you can create more money and try to outrun the debt with growth before the inflationary consequences catch up to you. That last one is the path governments almost always drift toward because it is the only answer that feels painless at first. The pain comes later, spread out, disguised, and pushed onto people who do not understand where it came from. That is the path I believe Washington is moving toward again right now. But this time the machinery is different. The route the money takes is different. And because the route is different, the consequences may not look exactly like 2021, even though the long-term logic is the same. Most people hear the phrase money printing and imagine giant presses running in the basement of the Treasury. That is not how modern money works. Money is loaned into existence. Every new dollar added to the system shows up with a matching obligation attached to it somewhere else. That detail matters because it means money creation can either be tied to real production or to political leakage. One leads to durable growth. The other leads to asset inflation, consumer inflation, and a transfer of purchasing power from the people who get the money last to the people who get it first. That distinction is everything. Let me make it plain. If every dollar in the country suddenly doubled in everyone, as a count at the exact same moment, you would feel richer for about 5 minutes. Then prices would adjust. A cup of coffee, a used truck, a roof repair, a doctor visit, all of it would begin repricing because the amount of money chasing the same amount of goods had changed. On paper, your balance would be bigger. In reality, your purchasing power would barely move. It would be like a stock split wearing the costume of prosperity. At the other extreme, imagine the government created a mountain of money and buried it where no one could spend it. The money supply would technically be higher, but because that money never entered real circulation, it would have no real effect on prices or daily life. No one could bid anything up with it. So the real question is never just how much money is created. The real question is who gets it first, how they use it, and whether it funds something that produces more than it consumes. That is where the last cycle went wrong. In 2020 and 2021, a great deal of newly created money did not flow through the economy in a way that increased productive capacity enough to justify the increase in claims on future output. Some checks went directly to households, yes, but the larger torrent moved through government channels, contractors, politically connected borrowers, emergency programs, and balance sheet expansions that favored the people closest to the spigot. By the time ordinary wages adjusted, asset prices, shelter, used cars, food, and services had already moved higher. The early recipients captured the gains. The later recipients absorbed the inflation. That is what happens when central planning determines the path of new money rather than decentralized market signals. Now we are back in another debt bind, and the government appears ready to try the same broad idea with a different delivery mechanism. The problem facing them is brutal. Debt relative to GDP is already at a level that tells you this is not a cyclical inconvenience. It is structural. The government's fixed commitments keep growing. Social Security grows, Medicare grows, interest on the debt grows. These are not theoretical line items. They are obligations wired into the political nervous system of the country. They do not step politely aside just because tax receipts soften. and that is the part people keep refusing to stare at long enough. In the 1940s, America hit an extraordinary debt load because it was fighting a world war. That is important because wartime debt, as destructive as it was, came from a temporary redirection of the productive economy. Factories were turned toward war output, men were sent overseas, the country strained itself to the breaking point. But when the war ended, the burden could collapse quickly because the emergency itself ended. Spending as a share of the economy fell. Those same factories could pivot back toward private production. The productive labor force could return to civilian life. In other words, the system had a visible off-ramp. Today there is no off-ramp. That federal spending is not perched at extraordinary levels because of a short emergency that is about to vanish. It has been creeping upward for decades. It is now rooted in entitlements, debt service, and a political culture that promises more benefits than tax receipts can support. That makes today's debt problem more stubborn than a wartime spike. You cannot demobilize Medicare. You cannot declare peace with interest expense. You cannot bring Social Security home from the battlefield. So the government borrows, then it borrows more to service what it already borrowed, then it tells itself growth will eventually save the arithmetic. Growth is the only elegant way out of a debt trap because if the productive pie grows fast enough, the debt becomes more manageable relative to the output supporting it. But genuine growth is hard work. It comes from better allocation of capital, more production, more productivity, more useful goods and services, and fewer obstacles placed in front of private enterprise. It comes from a government learning restraint, not just from a government learning new ways to lubricate the old machine. Washington does not seem interested in that kind of humility. Instead, what appears to be coming is an attempt to stimulate growth while easing the debt burden through a fresh wave of monetary expansion, but in a way designed to look more market-based than the last episode. That is where bank deregulation enters the picture. There is a regulatory mechanism hanging over the banking system that effectively limits how banks use their balance sheets. One of the arguments now gaining traction inside the policy world is that if regulators loosen or remove certain leverage constraints, banks could absorb far more treasuries and extend far more credit without hitting the same balance. Sheet walls they face today, to a politician or policymaker trapped inside a debt crisis, that sounds beautiful. If banks can buy more treasuries, the government has a larger buyer base for its debt. That helps suppress yields. Lower yields mean lower interest expense, or at least a slower explosion in interest expense. And if banks can also extend more credit to the private economy at the same time, then perhaps you get the miracle combination: easier financing for Washington, easier financing for businesses and households, and enough economic activity to keep the whole thing from toppling over. That is the needle they are trying to thread. And before you dismiss it, understand this is not fantasy. Pieces of this have worked before when leverage rules were temporarily relaxed during the pandemic panic. Banks did what banks do when the path is cleared. They lent, money moved. Activity surged, the system felt flush very quickly. The question is not whether loosening that mechanism can produce a boom. The question is what kind of boom it produces. There are two broad paths from here, and every serious investor should be thinking in those terms instead of shouting generic slogans about inflation or recession. The first path is the one policymakers are praying for. Banks use their expanded room to buy government debt. Yes, but they also use it to finance real production. Businesses refinance, healthy companies borrow to expand. New equipment gets purchased, credit flows into enterprises that create more output than the debt used to fund them. More goods are made, more services are offered, more real economic activity absorbs at least part of the new money entering the system. Inflation still exists because more money is moving around, but some of the pressure gets offset by more stuff being produced. The debt problem becomes more manageable, not because the government suddenly became disciplined, but because the economy got enough oxygen to keep running without immediately choking on price increases. That is the soft version. The second path is the one I worry about because it is so tempting. Banks buy treasuries because the carry is easy and the incentives are obvious. Financial markets get more liquidity. Risk assets levitate, private credit gets another pulse. Leveraged players breathe easier, asset owners feel wealthier. Yet the credit that reaches the real economy is weaker, narrower, and less productive than advertised. Money circulates first through the financial class, not through broad-based productive capacity. In that case, you do not get enough real growth to justify the expansion. You get higher asset prices, more expensive necessities, and a larger divide between people close to the money and people living on wages and cash balances. That would feel like 2021 with a better suit on. The reason this matters is because both paths can be bullish for assets in the medium term, but they are not equally good for the average household and they are not equally good for the long-term health of the economy. That distinction gets lost because most people still think in binary terms. They assume that if debt is bad, markets must crash. That is not usually how sovereign debt stress works. When the government chooses austerity, markets can suffer. When the government chooses default, markets can suffer. But when the government chooses financial engineering, money creation, and a new round of reflation, asset owners often do very well while people holding fixed claims, cash balances, and labor income get squeezed. In other words, the crisis does not necessarily punish markets first. It often punishes savers, wage earners, and the unpositioned first. That is why I keep coming back to the same harsh conclusion. If the government will not restrain itself and will not default, it will inflate. And if it will inflate, then your position relative to productive assets matters more than almost anything else. Now let me be precise, because imprecision ruins decision making. I am not saying every asset will rise equally. I am not saying every stock is safe. I am not saying every debt-fueled boom ends happily. What I am saying is that when a sovereign debt problem is handled with repression, monetary expansion, easier credit, and regulatory accommodation, the people who own scarce, productive, cash-generating assets stand far closer to the source of benefit than the people waiting in savings accounts, hoping the purchasing power of idle dollars will somehow survive. That is the game. And once you see the game, the portfolio implications become more obvious. Cash has a role, but it is a tool, not a strategy. If you hold too much of it while the authorities are trying to engineer their way through a debt trap, you are volunteering to be diluted. Long-duration fixed income assets can be dangerous if inflation proves harder to suppress than officials hope, because your nominal stream may remain intact while the real value of that stream gets quietly chewed apart. Businesses with pricing power, real assets, productive infrastructure, selected commodities, and productive equity claims all begin to matter a great deal more in this environment. Not because they are magic, because they are closer to the channels through which new money passes and more capable of defending their economics when the currency defending your savings cannot defend itself. I also want to say something that makes some people uncomfortable. The most important line in an inflationary or quasi-inflationary regime is not necessarily between rich and poor. It is often between owners and non-owners. A school teacher with a paid-off duplex and an index fund can be better insulated than a professional earning a large salary who rents, carries expensive liabilities, and holds excessive cash. A small business owner with pricing power can be more protected than a high-income employee whose paycheck rises slower than the cost of everything around him. The distinction is not glamour. The distinction is claim on assets. That is what policymakers understand, even if they never phrase it that way. They know they need people to keep buying assets, financing debt, borrowing, expanding, investing, and keeping the machine alive. They know a functioning asset market softens political pain. They know pension systems, retirement accounts, tax receipts, and public confidence all ride on some version of asset support. So when the debt trap tightens, they do not choose the route that crushes assets first unless they are forced to. They choose the route that tries to preserve nominal asset values while socializing the cost elsewhere. That is the essence of financial repression. And that is why the phrase money printer is firing up matters less than the phrase where does the money go first. If it goes first into government debt absorption and real economy lending, we get one flavor of this cycle. If it goes first into treasury support and financial speculation while productive output lags, we get another. But in either case, the investor who understands the plumbing is miles ahead of the citizen who thinks in headlines. This is also why I dislike the lazy phrase "this time is different," unless it is followed by a complete sentence. Of course, this time is different in detail. Every cycle has different delivery systems, different regulations, different political figures, different sectors leading, different language used to justify the same old instincts. But the broad moral logic is old. When debt grows faster than the productive base supporting it, governments eventually choose among pain, dishonor, or dilution. Pain is austerity. Dishonor is default. Dilution is inflation, repression, and monetary engineering. Washington has shown you for years which menu item it prefers. So let me bring this back to the ordinary person trying to decide what to do with a retirement account, a taxable brokerage account, a business or savings they are trying to protect. Do not make the mistake of waiting for perfect clarity. By the time official clarity arrives, markets usually have moved. Do not make the mistake of assuming the next debt management cycle will look exactly like the last one. The transmission path matters. Do not make the mistake of thinking you are safe, merely because you avoided volatility. In periods like this, apparent stability can be a slow motion loss of purchasing power. And do not make the mistake of believing you can out-argue arithmetic. The debt burden is real. The spending trajectory is real. The incentives facing officials are real. The only question is how they spread the burden. My own framework is simple. I want exposure to productive assets. I want as little dead cash as prudence allows. I want to understand which parts of the portfolio benefit if the government succeeds in engineering a reflationary lending boom. I want to understand which parts remain resilient if they fail, and simply generate another round of politically mediated asset inflation. And I want to be honest that the system, as currently designed, rewards people who move closer to ownership and punishes people who remain parked in passive dependence on the purchasing power of currency alone. That is not how the system should work in an ideal world, but it is how it works. So yes, I believe the money printer is firing up again, but it is different this time in one narrow and important sense. Last time the route of the money was obvious enough that the inflationary consequences became socially visible very quickly. This time they are trying to route the expansion through a mechanism that can be defended as market-friendly, bank-led, and growth-supportive. That might soften the optics. It does not eliminate the stakes. If they pull it off perfectly, you likely get a strong tailwind for asset owners and a partial escape valve for the debt crisis. If they pull it off imperfectly, you likely get a familiar transfer of wealth toward the people closest to the capital channels and away from everyone hoping salary growth alone will protect them. Either way, the lesson is the same. You do not want to be far from the assets when a debt crisis is solved with new money. You want to be as close to the receiving end of productive capital as your risk tolerance, skill, and discipline allow, because when the government cannot cut, will not default, and chooses engineering over restraint, the portfolio is not just an investment tool anymore. It becomes your financial lifeboat. Let me slow this down one step further, because when people hear banks lending money into existence, they tend to nod politely and move on without letting the implication land. A bank does not lend out a pile of cash the way a farmer lends out a tractor. In modern banking, the act of extending credit helps create the deposit that then circulates as money. That is why freeing bank balance sheets is not some sterile regulatory adjustment. It is a decision about who gets first access to tomorrow's purchasing power. If that credit goes to a small manufacturer buying better machinery, more output eventually comes into the economy. If it goes to a leveraged financial buyer rolling debt, a speculative fund, or a government issuing more promises, the money still exists. but the offsetting production often does not. Same mechanism, different destination, very different result. That is why two investors can both say the Fed is easing and still be talking about completely different worlds. One world is disinflationary enough on the surface that politicians declare victory. Credit expands, profits stabilize, refinancing pressure eases, and the economy buys time. In that world, quality businesses, productive property, and sensible equity exposure can do extremely well because nominal growth keeps flowing and the debt burden gets diluted gradually. The other world is uglier credit flows, but it pools in all the wrong places. Consumer prices rise faster than wages. Asset prices rise faster than consumer prices. Political resentment rises faster than both. People start to feel the truth that official inflation statistics often hide, which is that the economy may be growing in nominal terms while their personal flexibility is shrinking in real terms. That is how a country can look prosperous on paper and feel poorer in the grocery aisle, the housing market, and the insurance bill. I have watched that misunderstanding ruin decision making more than once. People assume that because markets are up, policy must be healthy. They assume that because the government is still borrowing, the debt burden must still be manageable. They assume that because there is no formal default, the system must still be honoring its promises in a meaningful way. But there is more than one way to break a promise. You can break it outright by refusing payment, or you can honor it in nominal dollars while making those dollars buy less. Every year politicians prefer the second version because it is easier to explain away, easier to distribute across the population, and easier to hide behind complexity. That is why I keep coming back to discipline. If you are a household, discipline means understanding the difference between an asset and a lifestyle expense. If you are a business owner, discipline means understanding the difference between productive borrowing and vanity borrowing. If you are an investor, discipline means understanding the difference between genuine scarcity and narrative hype. And if you are a government, discipline would mean saying no to promises that cannot be funded honestly. That last kind of discipline is precisely the one in shortest supply. So when people ask me whether I think the government can really stimulate growth and print at the same time without causing inflation, my answer is that it depends entirely on whether the new credit is allowed to flow mainly through productive channels or political channels. The root is the whole argument. The root determines whether new money behaves more like seed corn or more like accelerant on a fire that is already burning. This is also why I reject the lazy advice that tells ordinary people to just hold cash until the dust settles. Dust settling is a phrase people use when they want the comfort of delay without admitting the cost of delay. In an environment where the authorities are incentivized to suppress the real burden of debt by diluting the claims denominated in dollars, waiting in cash is not neutral. It is a position. It is a wager that the purchasing power of idle currency will hold up better than the assets being pushed higher by the response. Sometimes short-term fear makes that wager look intelligent for a quarter or two. Over a full cycle, it is usually the people sitting closest to productive assets who come out with the most preserved freedom. That does not mean recklessness. It does not mean leverage without margin for error. It does not mean buying every fashionable ticker and pretending you are protected because you own something called an asset. A bad asset bought at a foolish price is still a bad decision. A weak business with no pricing power can get crushed even in an inflationary system. An owner overburdened with floating rate debt can discover very quickly that nominal appreciation is not the same thing as resilience. You still need quality, you still need cash flow, you still need balance, sheet strength, you still need to know what you own and why it should survive if the macro thesis takes longer than expected to play out. But that only strengthens the point. The answer to monetary distortion is not passivity. It is selectivity. Own things with a reason. Own things that can adapt. Own things that can either reprice, produce, or preserve. And above all, stop confusing nominal safety with real safety. A savings account statement that never goes down can still represent a slow loss. A Treasury coupon that arrives on time can still underperform the inflation needed to manage the debt that made those treasuries necessary in the first place. Stability measured only in nominal dollars is an incomplete measurement in a system trying to solve excess debt with a larger supply of claims. That is the trap. People focus on whether the number of dollars changes and ignore what those dollars can command. If you want a one-sentence summary of the moment we are in, it is this: the country is trying to escape a debt burden, not by reducing promises, but by changing the environment in which those promises are carried. And when that happens, the smart question is not only what will the government do, the smarter question is what kind of owner do I need to become before they do it?